Welcome and good morning, everybody. I'm pretty happy that you're here so early on a Friday morning. Actually, 8:45 for me seems to be like at least 15 minutes too early on a Friday morning. But nevertheless, pretty happy to be here at the FXCM Algo Summit. Thanks for organizing the event to the team of FXCM here in London. My name is Yves. I'm founder and managing partner of the Python Quants. My talk is supposed to be a little bit on a higher level. So usually, maybe some who might know me, they know that I usually show a lot of code and practical examples, but my briefing was to go a little bit on a higher level and to talk about algorithmic trading in general. And my tagline here is how data-driven and AI-first finance change the landscape, and what this means for like algo trading in general in terms of like maybe algo trading, something for the masses. Maybe this could be also with a question mark, could be a question, but I think we are on the way here to see this phenomenon. First of all, like usual, high-risk investment warning. I'm pretty sure you all know that investing, and in particular trading, CFDs, FX-based products is related to high risks. So please read the disclaimer carefully. And also, external speaker disclaimer, we are in no way associated with FXCM. We work together on a contractual basis, but there is no kind of like relationship beyond that. And please read this external speaker disclaimer carefully as well. In what age are we living? So here is kind of a nice tweet from a friend of mine, Saeed. He was attending a conference recently, and I was surprised by the very number that was mentioned there, that we ingest. This is a quote from somebody from Google, not from Google. They ingest maybe more by Bloomberg. They ingest 1.5 million articles a day. I think this is kind of a huge number, 1.5 million articles. And this is unstructured data. This is text-based data, and this is supposed to be read, originally at least, by human beings. But I'm pretty sure that not a single human being, not even in a lifetime, would like to read 1.5 million articles. But this is what we are faced with in the financial industry. Ever-increasing data, ever-increasing information, and basically every second you get a few articles that are coming out, press releases and other data. So I'm in particular highlighting this because we are all used to ingest, let's say, structured data, numerical data, price data, historical data, real-time data. This is all kind of what machines have been built for in the first place. But these days we are faced with different issues with regard to unstructured data and text, which was originally designed to relate stories between human beings over generations, cultures, and boundaries. So ever-increasing data sets there. On the other hand, of course, we have machine learning techniques everywhere. So everybody who is wearing a phone or having a phone in the pocket, myself here, they have like machine learning-based approaches with them all the time. On every computer these days, you're faced with machine learning things. And it's not only that the big companies out there, the Googles in the world, the Microsofts, the Facebooks, are able to make use of machine learning approaches. No, we ourselves can do that. We ourselves, having just a regular machine in the form of a notebook, in the form of a desktop or whatever. Here I'm just pointing out two things that we use for our trainings, but also in trading, TensorFlow and scikit-learn. Me being a Python guy, scikit-learn is one of the most popular machine learning libraries and packages there. Application is pretty simple, and after, let's say, an instruction of 1, 2, 3 hours, everybody who has a little bit of programming knowledge can apply machine learning algorithms to whatever data. And for us, this might mean to financial data. On the other hand, I like that book. It's actually a German title. I was looking for an English translation, not yet out there. It's a relatively new book. And this is a book that explains how to build a self-driving car by the use of a Raspberry Pi and, for example, TensorFlow. And this is how far we've gotten. This has become really democratized. Not that the Teslas in the world, the Mercedes Benzes in the world, or the Ubers are kind of building or able to build, due to the resources that they have, AI-driven self-driving cars. No, we can do this back home in our basement. We can use our notebooks to do algo trading these days based on fantastic machine learning libraries. On the other hand, all this hype, but that's not only hype, because at least for me, hype has a little bit of a negative connotation. It's kind of the rise of AI over the recent years has spurred other developments as well. So it has become, according to an article, a recent article in The Economist from 7th of June, become sexy again to design chips. This has long been mainly constrained to Intel and AMD, and in the graphics sector we had NVIDIA. That was mostly it. But we see more and more well-financed startups these days that are concerned with the building of so-called ASICs, application-specific integrated circuit chips, which means that they are specifically designed to do, in general, one thing pretty well. So the development here is similar to what we have seen in Bitcoin mining, where in the beginning it was kind of completely okay to do the mining on your CPU, your general CPU-based machine. Later on, people moved to graphic cards because they were faster in coming up with the hash codes needed for the Bitcoin mining. Then people came up with the idea to use FPGAs, so configurable chips, in order to do it. But in the end, nothing could then beat the specifically designed chips, the ASICs that are in use around the world. And you can even Amazon order it for a couple of quids, like small USB sticks that have such a chip. So this is how far we've come here in this field as well. So it's similar to other developments, and probably a third of the new data centers of Google, where they have their TPUs, which is the same thing, tensor processing units, specifically designed to be pretty quick at processing what TensorFlow, the software, needs in the backend. All this, among others, leads to the rise of algo trading in almost any field. Actually, by this article, I was a little bit surprised in February that in the FX field, and obviously with FXCM here being our host, this is an important topic here, algo trading is not yet used that intensively compared, for example, to the equity markets. It's been a long while ago since the market share of algos in the equity markets, particularly in the US, has surpassed the 50% threshold. But here, there's no real number about market shares, but what the article says is that only 1 in 10 FX traders currently uses algo. So probably this doesn't translate to 10% market share, because those who are using it are probably the bigger ones, and the market share might be a little bit higher. But for sure, it's not as high as in the equity markets, where at some points during the trading day or the trading week and the cycles, 80–90% might be driven by algos already. But we see it's taken over all the fields, all the different asset classes, all the different areas. And basically, for me, working in more on the quantitative investment banking, corporate banking side, usually, I must say that retail has been more or less the trendsetter there. So retail banking in the sense of credit scoring, which are approaches from machine learning, they have been the first to make proper use of machine learning algorithms, but now it is coming to our field as well here. So we are set for major changes in the landscape, and what we are all after, this is more like, frankly, a fun quote that I have here. What we are all after is the Holy Grail of trading. That we say once we break the code of the markets, we get as rich as that. You know, we invest $1 million and we come out with 383 billion. This, of course, was paper trading. I'm not aware of any kind of liquid segment in the market where you could do this over the course of 8 weeks, so 38 million% return. I couldn't figure out what was kind of at least the basic idea or the type of strategies that they have used. Basically, this sounds like an arbitrage where you invest nothing and you scale up with nothing to infinity. Somehow, I don't know, maybe if somebody has some background information, I would be interested in doing that. But the hope is that by the application of AI-based approaches, machine learning approaches, that we can maybe not get such a return, but a similar return. There has been a question in the meantime.
Sorry, I was going to ask, you see the uptake in FX of algo trading has been quite slow. Do you have any idea why that might be?
Because many other strategies have been working that well in our field, in the FX field, over the course of decades, and seem to still work. In stock trading, this was, I think the motivation in stock trading is a little bit different to use algos, because many, where you have, first of all, the FX market is, of course, highly liquid. So largest volumes are seen there. It all started with algos that haven't been AI-driven at all in the stock market. It's more about like the execution itself, like, for example, selling a large block of shares, and to come up with some algo which minimizes market impact by this single sell, which might be split up in 100 smaller sales. So these strategies have been more or less about avoiding certain things and optimizing others, not to come up with trading ideas per se, what my talk will be mostly about. And again, I've been speaking to a few FX traders as well, and there were a few things simply worked that well over a couple of years, and there was obviously no need to pick up this early. But I think this will be coming because it will be all over the place. All right, the agenda for my talk. First, a quick introduction. I mean, this was the intro to the intro. A little bit of background, what I see as important developments. Introduction is a little bit more about what we do, what I do. Then I will dive into data-driven finance. We'll argue that this is kind of the prerequisite for AI-first finance. I will show how an example strategy using a typical comprehensively used machine learning algorithm might do for you. And then we'll talk a little bit about the AI machine, which I see which is a recent project that we started, which I see as kind of necessary ingredient to the whole story in order to bring indeed the masses to algo trading. And I will close with a quick outlook, and we for sure will have time for a few questions. Introduction about myself. The Python Quant is all centered around Python for finance, and since 2 years almost exclusively in algorithmic trading, in the form of training, in the form of what we do in terms of services. We are working with FXCM since last year, August, on the algo trading initiative. We have actually written the FXCM Pi wrapper package that is now available since March. For example, we have designed the training page, or the tutorial page, I'd rather say, so forth. But at the core, indeed, is training, content generation in the form of books. We run a platform with close to 15,000 users that are using Python codes for my books and so forth. So all around Python for finance, be it events, books, training, platform, open source, it's all the same core. tpq.io is our page where you find more information. More information with regard to my talks, like slide decks, like that one and so forth, are found on hilpisch.com. So if you're interested in our field, Python for finance, Python for algo trading, I think this is a good source. Also like gists and GitHub links with further resources to workshops I've given around the world are found on the page there. I might be kind of well known for the middle book there, the O'Reilly book. I'm in the course of updating it or upgrading us rather say, for the second edition of Python for Finance, and we changed the subtitle here, Mastering Data-Driven Finance. It has been selling kind of well, but it was published in print December 2014, and it feels already outdated because our field is evolving so quickly, and there's so many amazing things that have happened in the meantime that it was really overtime already in order to come up with the second one. You see my background in mathematical finance a little bit reflected by the derivatives books. They are more the quant books. The middle one is really more on the Python side against the background of finance. Data-driven finance, what do I mean by that? When I came over on Wednesday to London on my flight, I picked up the Financial Times because I still like to read the news and have this haptic feeling of having the newspaper in my hand and kind of like the smell of it, which is kind of typical, or to this and the Wall Street Journal when I'm in the US. But I'm pretty sure, and I think it's safe to say that not too many financial decisions these days are informed by reading the newspapers. I'm not saying that none are, but I think the majority of people who are kind of in charge of investing, trading, and other areas in our field, they are, if at all, sitting in front of something like what we see here. This is the HTML5 version, the web browser version of the Thomson Reuters Icon terminal. And for sure, if you're interested in anything about the Apple stock, for example, you might go to the terminal or to a Bloomberg terminal to this end. Then you find everything in a single place. You find it searchable. You can click on news. You can go to the financial figures, going back in time, historical price data, down to the tick level you can look up. So this is, of course, much more convenient than to sift through like 100 old newspaper things where you have the hope to maybe find something. And this is the standard since years. Still, people, of course, are reading the newspapers, but if somebody is really looking for let's say, fundamental information, news or whatever, they open their financial terminal, Bloomberg, Thomson Reuters, a few others, but these are, I guess, the two leading ones, and they get the information. But when I was saying before, for example, that equity markets are driven mostly by algos these days, this means that there are not even people doing the work, the searching, the reading anymore. It is the machines that are doing it. And here you see a few lines of Python code, which basically the upper end here, the most upper cell, retrieve tick data for a quarter of an hour for Apple stock, and a quarter of an hour worth of tick data for Apple at this day, at least for this particular interval, represents roughly 2,000 lines of code. And of course, working with tick data, you don't want to print that stuff, nor do you want to read through it. But the machine doesn't really care whether it's kind of like 2,000 lines, whether it's 200 lines, or just 5. But we as human beings, we probably care. Now, scale this up for a whole week. And here being at the FXCM Algo Summit, you have access to tick data, high-quality tick data, on the FXCM servers, and in the wrapper that we have written, you have easy functionality which looks similar to that one to retrieve such tick data. And for a typical FX currency pair, you will see that you have some 2 million tick data points per week. So for a single week, single trading week. And this is, I think, nothing you would ever print, nothing you would ever read through. But for the machines, this is what they are good at, going through that large amounts of data, and maybe not going through it line by line. We human beings will do it. The machine works with kind of complete vectors and crunches numbers at the 2 million level at the single step, actually. So this is what machines are good at, and I think we cannot compete anymore on this level with any machine that is out there, not even the smallest one. And this is how far we have gotten. End-of-day data is what most financial theories are still based on. So if you think of, I don't know, portfolio theory, Markowitz, or the CAPM, or all the traditional theories, it's all been based on end-of-day data. But we have moved forward to a world where we have, even as retail traders, access to tick data level, sometimes even order book level data, and this is where the machines are good at. But you might say, well, I still like to read the news because the news is about what is happening and so forth. But remember, 1.5 million articles per day. Who can read through all this? The machines can do. And here with the Thomson Reuters Icon Data API, you see it's a similar call, a similar method call, where I specify the RIC for the S&P 500, then Trump, and then that the language of the article shall be in English, and I get kind of like the articles delivered as well. First here, the storylines, and then I get, if I fancy, also the complete text. And these days, machines are good at reading the news as well. They are better, they are faster at reading the news. They can come up with sentiment scores saying, well, this is a positive article about Apple, about Trump, or S&P, or whatever, or currency pairs, or this is a negative article, or this is a neutral article, and much, much more can be done on this level. And of course, the machines are faster there as well. For sure, they don't get maybe the complete meaning, but if the complete meaning is kind of something that might be relevant, a human being could still have a look at it. But at the speed at which news are kind of disseminated throughout the world, again, human beings cannot keep up with sifting through all the articles, reading all the details, and getting an overview. This simply doesn't work, but the machine can do it. And even relatively small machines like my notebook here weighs less than a kilogram with an i7 in there and 16 gigs of RAM can do quite a bit with regard to text processing already. So data in this form drives finance. Not people reading the news, not kind of the news headlines themselves, is the data. And for a machine, basically today it doesn't make a big difference if we're dealing with historical price data or if we're dealing with unstructured data in the form of text, or let's say semi-structured data in the form of filings or financial reports and so forth. In order to apply machine learning algorithms or AI approaches in general, what is typically required is lots of data. So first there was big data, then there came the AI story on top of it, because it's a natural thing for all the algorithms that we have out there. They need enough data. I'm not talking about it doesn't necessarily have to be on a petascale, but there needs to be enough data. And in general, for example, in our industry, end-of-day data, even going back 30 years, it's not enough to properly train the algorithms, to fit the algorithms properly. and to hope for something. What we need is large enough data in the form of tick data, 2 million tick points per week, maybe resample to the second level or 5-second level. Then you easily come into the ranges where the algorithms are working. But data is the prerequisite for everything that is out there. Here's a nice little book. It's actually a small one like this, that's what I'm saying little, about the technological singularity, which basically stands for the hypothesis that at some point in the future, and this is then called the singularity, there will be a machine which has a general intelligence which surpasses our human intelligence. And not kind of like a chess program which is better than any human being. This is a specific intelligence. It's about the general intelligence. And what is pointed out here in 2015 is that today's algorithmic trading programs are relatively simple and make only limited use of AI. However, this is sure to change. AI is beneficial in any domain where patterns have to be found in large quantities of data and effective decisions have to be taken on the basis of those patterns, especially when it needs to be fast. So this is not a book about finance at all, but it's an area where the author touches upon 2015. And we have come a long way even since 2015. And I'm pretty happy that Marcos Lopez de Prado has published the first dedicated book to financial machine learning. Most things that you get are centered around packages, like you get many books on deep learning, the methodology, or even on TensorFlow, the package to do deep learning. But we are faced in the financial world with a few specifics that make adjustments necessary to the approaches. Basically with regard to the data, how you handle the data, what you do with the data, and this is what this book is about. And for me as a Pythonista, I'm of course happy that the code examples are written in Python. And there are kind of like a few interesting quotes in there. The first one basically saying that it would be really surprising that something as long known as multivariate linear regression, here it was already mastered by Gauss before 1794, should be able to explain our complex 21st century finance world. But still around our industry, and in FX trading it is also still the case, many models are based on linear, sometimes multivariate regression approaches. Statistical arbitrage, for example, and other strategies are basically using it. But what he's concluding, and I think we have now entered the stage, and in many areas we need to move on in this regard, that econometrics might be good enough to succeed in financial academia for now, although many people, of course, are working on fascinating stuff there. But succeeding in practice requires ML. So we need to move on. We need to be able to deal with non-linearities, with changing environments, and so forth. Happy to have this book around, and I'm pretty sure that there will be many more. It's like we see usual when we started out with Python decades ago. Python is already old. We had a few general books, and it became more and more specific. I think I was the first one to write a Python for finance book, but others followed them. Then we had pandas for finance and so forth. So we always see kind of like this specialization, and it's well reflected in the book market in general, if a topic is large enough. Speaking of patterns, machine learning and regression, and here being at FXCM, I'm pretty sure that most of you have been dealing with technical indicators with patterns. And the basic idea of charts is that once you see a certain formation, or in general terms a pattern, like the ones above, like bullish patterns, the idea is if you see something like this, the probability for an increase in the price, so here you see it's not about FX, not about stocks, it's simply agnostic, saying this pattern would say, well, the price, whatever the price is for, is supposed to increase, and you would be supposed to take a long position. Then there are bearish patterns as well, or reversal ones, or breakout patterns. There is, I don't know how many patterns there are out there, but these are, I think, 20 of the more popular ones. And I'm not arguing against or for such patterns. I don't know, who is trading based on patterns in here? Using chartists, patterns? Only one. The other ones don't dare. 2 or 3 don't dare to raise their hands. Again, I'm not arguing for or against these patterns, but what I say is that if there is something in such patterns, then one thing is for sure, that machines are much better at spotting such patterns and at acting based on patterns. So I think there's no point anymore for somebody sitting in front and doing some lines and trying to figure something out. The machines can do this in automatic fashion. And sometimes people ask me, yeah, but how do I teach the machine the patterns? And this is the nice thing about machine learning. Machine learning algorithms are supposed to learn the patterns themselves. Not these 20, maybe not other 20 popular ones, but if you provide the machine enough data, it will recognize, given certain patterns, what is more likely, that the price increases or decreases. And it's pretty simple to transform historical price data, for example, to fit into these, what are called classification, supervised learning algorithms, and to let the machine do the work, the groundwork. And this might be different. I mean, here, I explicitly said it, this is supposed to be agnostic, but who says that this holds true for FX as well as for equities? Or for bonds. For bonds, we for sure have different things, or interest rate, or let's say volatility index, or whatever. So, but again, if there is something in patterns, then machines are much better able to figure out what it is and to later on spot patterns, identify them, and to be able to react and act based on the patterns. In that sense, when we have a look a little bit further back in history, on the left-hand side, you see my highly simplified model of financial markets. So among others, one of the major functions of financial markets is to reveal price information based on what is coming in. And what is coming in is this little x there, lowercase x, and behind x are the 1.5 million articles, are terabytes and petabytes of historical price data, and so forth and so forth. So whatever this is, and this ever is increasing, so X is going bigger and bigger on a daily basis almost, is processed by markets in real time. And how these markets work, we still don't really know. We know it in certain areas, but not in general terms, like our understanding of the world and physics and physical laws is getting better and better. Even try to explain what the universe is doing over 1 billion years. But in terms of financial markets, they are nonlinear, they are complex, and this is not the major thing, but they are changing obviously over time. There are no kind of persistent laws in the markets that say, well, this, once you have figured it out, you can act on it for like years on end. This is not the case. But basically, in finance history, this is now the middle part, people treated it that way, in the sense of that genius brains sat down, pen and paper, came up with a couple of simplifying assumptions. And mostly these assumptions are characterized. If you have a little bit of financial background, you might notice and know this for sure. Normally distributed returns and linear relationships. But both of these, and these are two of the most central assumptions in our complete field, are proven to be wrong. So we have nonlinear markets, and you can pick out any financial time series, and in general, you won't have normally distributed returns. It's the absolute exception. But it makes for nice mathematics, for nice, short, concise proofs, where you can come up in the end with a nice equation. And for such equations, many Nobel Prizes have been awarded. And I'm still fascinated by that as well, because in and of itself, it's kind of a stimulating intellectual exercise. But historically, mostly the financial theories and the equations have been there first, and then people starting testing the theory empirically in the markets. And what they found out is that the brain-driven, beauty-driven approach simply does not work in general. So f of x, when I feed in financial data, I cannot explain what's coming out there. So there's kind of a mismatch. Now we are, I think, at the border of getting back to the scientific method in our field, because due to the increasing computational power that we have at our fingertips, I myself can sit down and can spin up cloud instances, as many as I want, for like a few bucks only, and I pay by the hour. I have computational power at my fingertips that 10, 15 years ago, only the big institutions had available. I have the data available. I was talking about FXCM tick data, 2 million tick data points. I take a couple of them. I take 2, 3 years worth of that. I have big data. I need big machines to process it. But nevertheless, I can do it. Me, as a retail trader, I can do it. And I can apply the nice methods. I can apply TensorFlow and train deep neural network classifier algorithms on top of that. And it might not be as elegant like a single line equation, which is supposed to explain the markets, it might have some issues. There are many research papers these days arguing about the black boxes that we are faced with when we use complex networks, for example. But in the end, if the result is that my trained models, maybe trained over the course of a few days even with the big machines, are much better at explaining what X will give us, namely the Y, the output from the left-hand side, then I would say that data-driven and AI-first finance is actually something I would prefer, at least from a business point of view, an economy point of view, compared to the nice, elegant, beautiful equations that have driven our field for quite a while. And again, I must say all the beautiful equations, and back in the days, they might have had a little bit more explanatory power, all based on end-of-day data, but we have left this. Markets are not driven anymore by the Wall Street Journal that is published or the Financial Times that is published in the morning, and people pick up as early as possible. The machines are crunching the numbers in real time and reading the articles in real time. So data as a prerequisite, data availability, and I'm arguing here in algorithmic trading for the masses. If you want to do, for example, FX algo trading, you have all the data available that others, the big players, have as well. Maybe not all, but almost all the relevant data. And you have also the algorithms, and you have the infrastructure, the computational power, if you fancy, to apply all this. Because for sure, to evaluate the CAP-M equation, this is a simple thing. You can do it with pen and paper, but in order to do a training of a deep neural network, you might need even specific hardware like GPUs, but if you have kids back home like myself, you will probably have a machine with a GPU already, which you can use to train your model, because it's the same problem, so to say, in the same use case as for the games that are played these days. In that sense, for the first time, that's my argument here, we are driven in the financial field by developments that have started in completely different fields. So here, one of my standard examples, this relates to the little book that I've shown before. In the self-driving car area, many developments have been made based on data availability. They have trained also the algorithms, for example, based on Grand Theft Auto, which is a computer game itself, but they need, let's say, 1 billion hours of driving, but it takes kind of like ages until you have a physical car driving for 1 billion hours, even if you have 100 cars driving. So they started training the algorithms based on virtual worlds, which seem to have worked out pretty well. Using sophisticated algorithms, for example, TensorFlow is used in this area by Google, and specific hardware. I've been arguing about the hardware itself. And the middle part, optimization, training, testing, validation, these are the typical tasks of a data scientist or somebody who wants to apply these methods. And I think it's the same mostly, no matter whether you want to build a self-driving car or if you want to come up with an AI-based algo trading machine. You can apply same algorithms, you can apply the sophisticated or use sophisticated hardware that is available. Your middle steps are the same, but of course you're dealing with different data sets. So driving a car around the city, of course, relies on different data sets compared to what we need in the financial markets. But I think we have basically 2 areas where the trading problem is more simple, or at least not as risky as the problem of a self-driving car. The first is, of course, that we don't have any physical component. So people building a self-driving car, at some point they need to get this physical thing out and running. And of course, once you have something physical moving around the city, there are risks, and we are all aware of recent accidents that have happened. So at least here in the AI business, we might lose some money, which might be annoying, and you might be upset, but at least we cannot kill anybody when we do something wrong there. So our problem is a little bit easier in that sense, but nevertheless, we can make use of the interesting and fantastic things, and most of these are available. Again, my argument, algo trading for the masses, for us retail traders as well, not only for the big institutions that have millions and millions of budget to be deployed to such a field. Now, a little example strategy, and of course, you have seen the disclaimer. This is not about any investment advice. This is just kind of a little example how you might apply something to come up with a strategy. that might be working. I'm not going into details, but I want to show you a few results and how this might behave and how we go about backtesting of such strategies. And basically the one that I'm showing is already in production, still, let's say, a test phase production with small amounts of money only. But this is something which is run already almost on a daily basis. So the basic idea is that we are dealing with a single instrument, say an FX pair. We do some leverage trading, long and short, mid-frequency. Here it's not. And maybe I should clarify that as well. When I speak of algo trading, I'm generally not on the high-frequency trading side. So it's rather mid-frequency, where I think AI might provide some advantages. The high-frequency trading business, which also uses algos, different algos, relies more on the speed advantage based on hardware, co-location, and so forth. So here I'm talking rather based on 1 minute, 5 minute, 10-minute bars, not high-frequency. The algorithm is a standard one, might be Bayes or logistic regression, similar algorithms. The goal is alpha, and I define alpha as, first of all, outperformance, but outperformance is not enough for me, of course, because if the market goes down minus 10%, I wouldn't be satisfied if I get minus 8% out of that. So it should be an absolute positive return, and it should have a low correlation. Low correlation meaning that I would expect some positive returns in all cases, whether the market goes up, whether the market goes down, or if it stays kind of like on the same level. This is what I understand under alpha. Robustness, it should show acceptable performance independent of the parameters. So our industry, and in particular with the algorithms I'm mentioning here, there's kind of a big issue with regard to overfitting. They just say, well, in sample and tweaking the data or the parameters long enough, I will come up with fantastic returns of whatever type you're expecting. But I'm rather on the side of saying, per se, I don't want to avoid overfitting. This is not kind of my primary goal. I'm rather saying I want to have a type of strategy which is mostly insensitive to the choice of parameters. So if the idea is correct, I can live with a little bit of a lower return if I avoid overfitting there, or a little bit of a higher, depending on how the market goes then. Programming, it's only standard stuff. Everything that I'm showing here has been derived based on actually publicly available data. If you have, like here with FXCM, if you have a demo account already, you don't even need to have a, let's say, a real account with proper money and with open source. And it's done on a notebook. So it's nothing here which in that sense is specific. So the whole strategy idea and description fits pretty well, exactly, I must say, into what FXCM is providing you with these days based on the Algorithmic Trading Initiative. I'm not saying that's the only place where you could go and try to implement such a strategy, but it fits perfectly well into what FXCM is offering there. So here you see the first results. I'm basing this on Euro-US dollar 5-minute bars, and I do sequential training and backtest. Later on, I show you another chart where I do randomized training and backtest. Basically, this means that I have a data set. And you see in the third bullet point, I take the first 40% to train the model, and I take the other 60% to test it. So this is the first thing to avoid overfitting. But still, even under these circumstances, you can go and do overfitting in the sense of that you redo your test. This is some people, yeah?
So your split of train versus test is a lot lower than what sort of scientists would do in other fields of machine learning. Why would you do 40-60 rather than something like 80-20? That is more typical.
Yeah, that is typical, but it's then even easier to get an overfit accomplished. So I'm rather here on the cautious side, and I'm saying, since this is a pattern-based approach, I'm saying if there is something in this pattern argument, again, it's just an if before that, then it should persist, and it shouldn't make that much of a difference whether I train it on a relatively small, the data set needs to be large enough. But I'm rather having, like, when I come up with a strategy and a type of strategy, I would like to have this to be consistent then over time as well, and not kind of like, I mean, some people train their models on a complete data set and then test it day by day on a single day. There's so many approaches that I've seen, but I think for us in the financial field, I try to be as far as possible on the cautious side and not doing some 80-20, 90-10 thing where I say, well, these 10% work pretty well, but I'm rather interested the other way around. You know, if it works on train 10% and testing on 90%, I have a better feeling than with the other ratios.
And this temporal relationship is you always just, how do you sample the data?
Here it's sequential. So indeed, this is what many people propose to say, well, today we have the 15th of June, I have data available up until today. Maybe I start at the beginning of the year and I take the first 3 months to train it and then I test it afterwards. But again, if there is something in patterns, it shouldn't matter if I reverse the sequence. So I could train it in the later part and go, but I will show you test results where I do random train test split anyways. So.
What's that on the y-axis?
The y-axis is the relative performance, so it starts at 1. So this is normalized. So if you would invest like 10,000, you can scale it up. You see the 3 differently colored lines. The orange one is the base product, the underlying euro-US dollar. There's no leverage here shown. So this is more or less moving sideways, losing a little bit. The blue one is the strategy itself without transaction costs, and the green one is the strategy minus transaction costs, which takes into account the number of trades in relative terms. So of course you lose due to trading because the strategy will implement quite a few trades. So it won't hold it over like 4 weeks and then change it once and go to another thing. Yeah.
How is this out of sample results?
This is out of sample. Yeah.
The second question is, are they calculated after costs and commissions?
This is what I was saying. The middle line is after cost and commissions. You see how much you lose due to transaction costs. It changes even the slope, the average slope of it considerably. The green one is still positive in that sense, but much lower, like 2 percentage points over time compared to the one without transaction costs.
It actually you do a few trades during Monday or Friday, right? This is the strategy. Supposedly it's per week, right?
No. This is 5-minute bars. So it's multiple intraday trades that are below that. This is an intraday strategy.
If you see you have fewer trades on Mondays and on Fridays, right? This is, if I understand it's flat, this is where it's flat, right?
No, this is during the weekends. This is where trading is closed. This is where trading. This is multi-weeks, you see. Yeah, so.
You have mentioned over there 40 to 60% train and split ratio. Can you give us some example when we are talking about training? What exactly are you training the algorithm? Give us some more example, possibly something which you like, something which is easier for us to understand.
What do you mean by an example for training? Which algorithm I've used here? Actually, the whole idea behind this is that I don't want to go into too much details, but I relate it to another strategy. Not what this is doing, because we're training it on ourselves, but basically the standard would be for such an algorithm to say, well, I create a prediction whether, given all the information up until now, I assume, the algorithm, that the pattern that I have observed, whatever this is based on, we talk then of features, I come up with a probability for an upwards movement that is higher for a downwards movement. So my prediction would be that the market goes up and you would enter a long position or stay in a long position. If the algorithm says the probability for a downwards movement, given what I have observed, this is indeed the pattern idea, is higher, then I would enter a short position or stay in the short position when I'm short. So the algorithm here basically is always invested. And it just changes if the algorithm says, well, you are on the wrong side given what my prediction is. Of course, you can come up with any other idea, everything in between, just entering when you see a specific situation. You could, for example, this is also easy to implement, say, well, I'm only go long if the algorithm predicts an upwards movement, not only with 50-point-something%, but with at least 60%, given the historical information. Otherwise, you wouldn't enter. And vice versa, if you say, well, if the algorithm says the downwards movement is now at the level of 60% confidence, then you would go short. And in all other cases, you might want to stay neutral, for example. You have all the algorithms give you that information in order to act on probabilities as well. But in the basic case, you would say, if the probability for the one side is higher, then I take this as a signal for that direction.
You were talking about a separate process, considering giving the algorithm 30 years of data or 20 years of data to make it learn about different patterns and what happened after that, after the start. And then this process, what we are talking about with this chart, what we are saying is this a separate process than the previous learning process, or?
Exactly. This is what you would do, that if you have, let's say, 1,000 data points, you wouldn't go and train it on 1,000 data points and test it on the same 1,000 data points. You would say, well, algorithm learn on the first 500, and we test it on the other 500, because this is, of course, much more realistic. Like in practice, again, we have data up until today now, at this point in time, but if we get started trading, we are dealing with unseen data. And this unseen thing is something that we simulate by what machine learning practitioners and academics call train test split. In finance, you sometimes hear also the expressions in sample versus out of sample. But it's basically the same idea behind that.
So I guess your predictive model here gives you the entry points, I would assume. Do you also use your predictive models to manage the trade and to exit?
Sure, in that sense, as I was explaining, so many different, even with the same algorithm, you can implement different types of strategy afterwards. So currently, what I'm saying, if we, and I speak for ourselves indeed now, do the trading beyond any potential stop losses or take profits, it stays in a position until the signal changes.
Okay.
So we work with stop loss and take profits. But if the signal changes in the meantime from long to short, then it would reverse the position. But not kind of like saying for like, we stay in there for 4 hours maximum or something. If we take profit, yeah. If we hit or if we stop loss, then it goes out and re-enters after it sees certain conditions fulfilled.
What are you counting as expenses?
Bid-ask spread mainly.
So you're including the bid-ask as an expense?
Yeah.
So is that vary?
If I look over there, I'm sorry.
You're varying your expense number, so you must have another input because your expense will change, but it won't be consistent.
Yeah, but it's here normalized to a certain level. So it's a little bit of a simplifying assumption for sure, but since it's normalized, I think we are hopefully not too far away of the real ones.
It'd be easier to test it with a ticket price you're paying per chunk. Rather than paying at the spread, you have a better analysis than paying the ticket price.
Can always get more detailed. This would then require a different backtesting approach to the approach of vectorized backtesting that we implement here technically doesn't allow for more sophisticated elements. So we would need to have a different way of backtesting it. Yeah. But I think we are kind of like, on average, it shouldn't make that much of a difference. With indicators, you mean things like RSI or simple moving averages or, sorry?
Beyond those, are there any things that you also found useful? Have you rolled some of your own indicators or any alternative data sources? Or say, for example, this model, without sort of giving away too much secret source, how did you go about the process of finding these features, the inputs for this model, then feed into your
I can tell you one thing, this thing is only based on historical price data, what you see here. But nobody prevents you from adding whatever you want to. This is the nice thing and the flexibility. Even when people argue like, oh, but I like to trade based on RSI or whatever, you can use it as a feature here as well. So, and if there is something in it, then the machine will figure it out or it will dismiss it. From my experience, adding traditional indicators doesn't improve it in many cases worsens it, because there might be, due to overfitting then, given some historical constellation, it might make it worse out of sample. It might improve it considerably in sample, but the robustness moving out of sample might not be given anymore. Basically, there's a whole bunch written in the book that I pointed out before, Financial Machinery, which focuses on the coming up of features and the research, but this is indeed for most people the secret source. There's, I have even on my notebook here a couple of research papers that try to figure out the helpfulness, the input of certain features when you do algo-based FX trading. And it's kind of like mixed results. Again, in sample and all these research papers, I can get any result that I want to, but the open and frank question, I don't really know what works. This is based on a slightly different approach, but I can tell you that much, that it's based on historical price data only. And I started out with a larger set of features and I narrowed it down, and this narrowing down improved it considerably. So, but when I hear people saying, well, we trade on 120 feature, we train the model, and from my experience, it doesn't improve the thing at all.
How many features would you typically sort of distill down for a particular model we're looking at now? 1, 3, 8, something around that?
15, 20. But it's not like, it's not the type of feature, it's a little bit. And again, I'm not doing this kind of like investment advice. So what we typically do, we do this for ourselves, and we teach how to apply it and how to empower people, even retail traders, to this end, this is my argument, to do their own research and to figure it out. I mean, there are even libraries that help you in figuring out which time series-based features are helpful or not. So even this part of the research process can, to some extent, be automated. TS Fresh, for example, is the library in our field where they test like 200 typical time series-based features, like simple one, maximum, minimum, rolling window, blah, blah, blah. And they figure out, or this package figures out on its own, what really has explanatory power in your context. So many questions in between it.
Cost. It is the most important variable, in my opinion, when it comes to trading. Okay. I was wondering, have you tried testing, training your models, considering costs in the model? So if, for example, you mentioned the bid aspects, you can go beyond that. It could be 2 or 3 basis points in and out. Using it into the trading process, do you see difference in the results compared with not considering costs in your experience?
We haven't included this as a target variable, because we change the time horizon, and with what we do, we don't see too many trades. So that I said, well, if there is something in it, if the whole thing dies due to the spread that we have, then I wouldn't trade it at all. So when we worked with kind of smaller timescales, 10 seconds, 1 minute, then the problem magnifies, because if you see like 30 trades per hour, probably eating into the small amount that you can make over the short period of time. And that's the issue, kind of like holding period. And here there might be a change in direction, maybe every half an hour, every hour or what, with what we do. And this leads to just much fewer trades compared to high frequency. It's one of the reasons why we change a little bit to the mid size. 5, 10 minutes. To have a look at the time, yeah.
What kind of strategy do you use in order to produce this kind of results? Something like a trend following strategy or something like a mean reversion strategy based on the signals?
It's neither trend nor mean reversion. It's neither nor. It's no.
But I guess you must follow some specific strategy based on the signals, right? Because based on the signals we can produce big strategies, not just one. So this is
Actually, this type is predicting a range for the price based on patterns. So it doesn't care about mean reversion. It doesn't care about if there is something in mean reversion, like the pattern can be a mean reverting pattern. Yes, this is a trend thing. Then yes. So therefore, I say neither nor. It's based on patterns, not on some idea of trend or mean reversion. It predicts a level, and based on a level in a sense of kind of like an interval, not kind of like a number.
okay, but in order to take advantage of this signal, you must have a specific strategy in order to get the specific results.
Sure.
So what is this specific strategy?
That if I'm on, it's as simple as that. That if I'm on a different level, and say I'm on level 5 and it predicts level 6, then I would go long, and vice versa.
Yeah, but
If it predicts the same thing, it wouldn't trade at all.
yeah, I understand. This is a little bit general what you are saying, but this is some very specific because it is specific enough. So the stop loss of the take profit level must be some, let's say, predefined numbers, right?
Sure.
So can you reveal this or what?
I think we should maybe later on. Unfortunately, I'm not able to stick around today because I need to catch my flight. But I have a little bit more like I wasn't expecting. I've never got that many questions to the single slide here. I see many traders in the room. Here you see kind of the same strategy now, backtested differently. You see, this is a randomized strain backtest. So I take kind of the sequence of things and I shuffle it around, because if there is something in our pattern-based approach, it shouldn't matter whether the pattern is kind of taken from the very end, or from the very beginning, or from the middle of it. So again, this doesn't, of course, answer your question with regard to the specifics of the implementation, but it's not anything really sophisticated behind the algorithm in that sense. But of course, we do this on a much larger scale, and you can do this on such a small machine, once again, using Python, and you see the results here. On the left-hand side, you see the performance, left upper-hand side, you see the performance of the strategy, on the right-hand side, without transaction costs, and you see, depending on the algorithm configuration, transaction costs might eat into the results even until you lose money in absolute terms. But what is kind of nice to see there is on the green ones, they are kind of like the market benchmark returns. So you see they are bucketed. And there are cases where we are close to zero, where we lose quite a bit of money, where we make quite a bit of money by simply passively holding. But no matter what the market itself is doing, by what I'm doing here, you see that the strategy is able to create a positive return. Not considering transaction costs all the time, but it's kind of like stable, and the outperformance on the right-hand side is shown here as the violet color. So these are 288 algorithm configurations, and this is what I meant by robustness, that I don't have one algorithm tested and trained on one data set, and I come up with one specific set of optimal parameters for that. Now it's kind of like, basically you see it here, I can do many different things, and there seems to be something behind it. And with the approaches that we have, it's easy to implement. I mean, this might take, on a smaller machine like mine here, this might take 2, 3 minutes, 4 minutes, but it's still not kind of like days or weeks to come up with the results here. So easy enough.
Hi, can you just talk a little bit about the robustness of your results? So one of the things I look at is kind of like a z-score of results. So you take the standard deviation, so z-score of the trades, the returns. You take standard deviation of the returns and divide it by the square root of the number of trades you've got, just so that you actually know whether or not it's really a real number that's coming through, or whether it's, is it beta or is it alpha, essentially.
Yeah, we do quite a bit more in this regard, but I don't have it here on the slides with me. So because this is all based on a large Jupyter notebook with lots of code and calculating different risk measures, going through things like drawdown periods, maximum drawdown, and all the risk measures that we consider interesting there, but I'm not reporting here on these in detail. Yeah, I agree, and we had issues with regard to profitability based on just direction-based trading strategies. So what you're saying, kind of like up or down might be one thing, but you might, even on a 5-minute level, you might easily get kind of up prediction, down prediction, up prediction, down prediction. So you would be trading all the time, and you wouldn't have enough time probably to make a decent profit, which would be enough to cover your expenses, your transaction costs in this regard. So that's the reason why we changed to this level-based prediction. So that we say, well, if we do something, then it should be based on a prediction which is far enough away, so to say, and not something where we say, well, an upwards movement might be minute, and you might be completely correct with the upwards movement, but still it might not be enough for you to come up with a profitable strategy. That's the reason why we changed from the purely directional trade to something which has a broader bandwidth, which actually lowers considerably the number of trades, but gives the algo some time to prove that it was right in that sense. Five-minute bars or 10-minute bars. But we try to trade exact. So we have a slippage from analysis of incoming data to confirmation or reversal of the signal below 1 second. So the trade is executed usually. The whole thing, when we get the tick, the final tick or the interval that we trade on, should be taking less than 1.2 seconds, let's say. Usually it should be below 1 second, but it also depends on when we get the last bar, which is relevant to inform the signal.
Maybe there, but did you just run a randomized? So did you just have another thing running in parallel, which just went up or down randomly to compare to what you came up with?
You mean to test it on something like a random walk?
Well, so if I understand correctly, you're taking a trade at the maximum once every 10 minutes on that method.
Yeah.
Which could be once an hour or once every 10 minutes. But did you do a thing at the same time, or you just had a random thing saying up or down and compare the results?
But how? What do you mean by?
Every time your system might anchor straight,
Yeah.
you get to a 10-minute point and it goes up. At the same time, running at the same time, did you run something that just randomly said up or down and then compare the results?
I mean to like the monkey thing that I have like some stochastic process which gives me signals.
If you're doing a trade every 10 minutes, which could happen, you could just be random. You could end up with just an average result.
To answer the question, we didn't do it, no. But I wouldn't see the exact point of doing this
You
exact.
ran something that's just randomly just saying up or down and then compared it to the result.
So you think if the random thing performs exactly the same way,
Well, not whether it's the same or better or worse, it would just give you another way of dealing with
a baseline compared to if there is some information in it.
exactly the same way as the end of each day, you might get suspicious hits that you.
Yeah, but we didn't do that one because I wouldn't expect to be any additional information here. Yeah. Sorry? Stop loss, take profit, or change?
And then
Sorry?
Is that basically the meta parameter set?
Yeah,
Right.
the 288. Like 15 lakh, 20, like changing different things with stop loss, without stop loss. Stop loss doesn't have too much of a difference.
You showed these results in your algorithm, and in the beginning you mentioned that you use leverage. Is your algorithm dependent or very dependent on the leverage you use?
No, no, no. The results that I'm showing are unleveraged. This is what I was saying to the chart. So the results are unleveraged.
What is your experience in and around speed of execution? Give an example, you have an X powerful machine with a number of cores of very good internet or staying closer to the exchange. What's your experience around the speed of execution?
Currently, what we do, we have a server running, cloud instance, in the UK actually, and turnaround times for the trade itself are some 150 milliseconds. But it's not the local machine, it's not kind of like it. Because, I mean, if you want to have fast internet, fast machines, put it in the cloud. In particular, if you want to run it 24 hours. So I would never recommend that you do anything like this from back home. You can do it from back home for you as a person, logging in to the server, but the thing should be running out there. Again, this was, I'm a little bit surprised here by all the questions. This was just supposed to show how easy it is for someone like me or someone like yourself or someone you might know who has a little bit of Python programming experience in my case and a normal machine that they can use all the nice approaches based on historical intraday data using sophisticated machine learning algorithms to come up with something I have been showing. But we have a little bit of background here. Now, how do you get this into practice? I mean, there have been so many practical questions around here, but I think this is the most important one. You can have the best algorithm. You've done your research for years on end. You have 150,000 people and more on Quantopian who come up with Python-based algorithms, and the average length is some 250 lines of code, so a little bit less actually there. But from the 150,000 people, I think less than 150, maybe even less than 15 have really deployed their algorithm on a kind of systematic, proper basis, robustly, reliably. Because, and yesterday I had kind of a nice chat with a guy from Thomson Reuters when I was at the Dev Day there, and he's a well-versed guy, and he's running his own cryptocurrency arbitrage strategy, and say, you know what the major problem is for someone like me? My algo for arbitrage is less than 100 lines of code, but I've written 22,000 lines of code to connect to 6 exchanges and to get this up and running. So it's 100 lines of code like this, and you have this deployment issue. And this is a PhD and in research and machine learning expert, and we saw the same thing working with FXCM, doing that many trainings. The platforms, of course, want to get the masses to algo trading. We try to empower with our trainings to get the people to that point, but there is still what we call the deployment gap. Here you see our program, 16 weeks, 1,200 pages, close to 200 hours of instruction, Python for algo trading. And my vision back then when we started was to empower people after the program to be able to get up and running with the algo. But 100 lines, 22,000 lines. So there is simply the deployment gap. Companies like FXCM doing a great job to empower you to do algo trading based on proper infrastructure, API, Python, FXCM, Pi, wrapper package, doing education, doing kind of like events like this one. We try to train the traders and the researchers. We provide practice experience. Platforms like Quantopian provide research environments and so forth. But still, we have this last mile problem, the deployment gap, because it's still due to lack of skills, budget, and time. And even if you say, well, I can invest like my spare time over 2 years to get up and running, but I think not too many people are willing to do that. And what we are working on is, and it's now in production for our own, it's the AI machine, which basically takes care of all these issues, like question with regard to turnaround times, placing orders, keeping up with it, with regard to digesting all the tick data that is coming, depending on how many strategies you trade, it might be quite a bit. to create in real time the signals based on your trained model, to take care of every single trade, to take care of stop loss and take profit things, to do visualization in terms of like what is going on there, real-time P&L. Because the platforms, on the one hand, making a great job in supporting you with regard to a single trade, but if you think in terms of such an AI-based algo trading strategy, you might end up with 100 trades over the course of a week or 500 over a month or whatever, and P&L of such a complete sequence of trades is a little bit different, and you need to be able to keep track of all that. And this is what the AI machine is all about. This is scratching my own itch because I wanted to have something which allows me to deploy in standardized fashion with standard APIs, this thing. And basically my goal, my approach is that the machine should close this deployment gap. That people that come, for example, to our certificate program after 16 weeks, they have all the background information. They are able to come up with their 250 lines or 300 lines of algo code, but they don't want to write, we are well beyond 10,000 lines of code with this thing for sure, and using many different technologies like RabbitMQ, AngularJS, Python, blah, blah, blah. There's so many things that we use there, and for sure not every single retail trader who wants to do algo trading has the time, nor the skills, nor the budget to come up with it. But with the machine, our vision is kind of like to empower people who have the background, who can do the coding for the 200 lines, 150 lines. It can be as simple as 50 lines or as complex as 500 lines, but still it's a difference to the 10,000, 15,000 lines that you need to properly deploy it and to allow for standardized deployment, data processing, and strategy lifecycle management. In that sense, we are not mostly concerned, primarily concerned with kind of the intelligence. You as traders, as investors, you have the intelligence, you know what you do. You might maybe add to your tool set some machine learning aspects if you like to afterwards, but we are concerned with the body, not with the brain, with the body. I mean, we need the body that is kind of carrying around the brain. And this is how we think of the machine, or like the rocket, which allows you, as people want to make use of satellites in the sky, to deploy that stuff. So the machine is up and running, and you will hear more in the future. If you follow along, you can follow me on Twitter. I have tweeted about my talk, the slide deck here if you're interested. So if you go to DYGH on Twitter, you find the link to my slide deck with all the information that you have seen there. If you follow along, you will hear some new stuff that's coming out, events and other things that we are doing. And the machine is supposed to be something where we have real-time risk audit. Unfortunately, the resolution is not too good here. But you see kind of how this works. The strategy is running, like 2 in this case, and you see the green triangles and the red ones where you have an upwards prediction, downwards prediction. You see the price ranges going over there. You have real-time P&L positions. You can zoom in and zoom out. And this is what we want to accomplish with that you have this standardized approach. Still not finished, but I think we are now at the base camp maybe, but summit is still a few thousand meters higher, but it is trading on a daily basis already. Bring me.
Sorry, the AI machine deployment thing, is it within the FXCM or is it something separately?
This is something separately. So we have FXCM, we have our training and many others that apply, and we are now working on this as a currently internal project. And we haven't decided this yet. It's too early. So we just tested for ourselves, and once we have kind of a good feeling, we will discuss business side of things then. Currently, we haven't planned for GPUs, so but you could even provide your trained model and to get it deployed. This is how it currently works as well. So on the deployment side, if you have a Python pickled object, for example, you can have your IP deployed there.
In that case, does it come with a data set or going to source the data set as well?
No, we are not. We are no data providers. We work with companies like FXCM. We work with companies like Thomson Reuters, but we are for sure no data providers. It's not part of our business model. In that sense, it should also be agnostic, platform agnostic. But I think with FXCM, you get access to basically everything you need in order to get up and running with that. A few closing remarks. So a little bit of an outlook. Algo trading for the masses, one of my favorite quotes here from Terminator 2. Here you see a quote from a book about financial singularity. It's called Superintelligence, another word for general AI. And Nick Bostrom, one of the popular researchers in the field, predicted in 2014 when the book came out that it would take 10 years until Go-playing programs beat the Go world champion. But you might be aware of the story. It took 1 year longer until the European champion was beaten. It took until 2016 until the world champion was beaten, and AlphaZero in 2017 beat the previous master program, so to say, after a few hours of training. So we are evolving pretty fast, and not only are the algorithms, here in this case AlphaZero being a self-reinforcement learning algorithms, not being good at Go only, being better than any other chess engine out there as well, are getting better and faster. On the other hand, getting back to the little hardware story, the requirements to do this are coming lower and lower. You see the lower chart here showing the power consumption starting with 176 GPUs going down afterwards for AlphaZero to 4 TPUs only. It's a significant difference here in power consumption. And when people talk about edge computing and that Apple is now building an AI chip into the iPhone X, we will have this kind of in any area in that sense. So I'm pretty sure that all these developments happening currently, mostly in other fields, will significantly and for a long time influence what is happening in the financial industry. And I'm pretty happy that it's not something for the big institutions with the millions of budgets only. It's something for us retail traders as well. So algorithmic trading for the masses is there, and I think it will be staying there for a long time. Computational explosion, you can read it as you like. Quantum computing, this is now a little bit of an outlook. Maybe not for the masses currently, but one day we might have quantum computers there as well. But in any case, I wish you successful trading and a nice day here. And I say thank you.